Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to the Foundation for the Study of Cycles. My name is Lars and we have another episode of Cycles TV. Today we have a special episode because we have a special guest today, which I'm very proud of, that he will join today. So Peter Eliades is with us for this special episode, and we want to discuss some current global market analysis and the current status quo of the different approaches, how we can use cycle analysis in the current market analysis. That's the topic for the next 45 minutes. And I'm, as mentioned, very proud, Peter, to have you here today. So welcome.
Thank you very much, Lars. It's fun to be with you. I always enjoy discussing the market with you and specifically cycles.
Yes, we did this in October, November last year. We started the discussion. We talked about the possible topping October, November already last year. Just a quick introduction for the audience maybe who is not finally aware, but Peter is a legend in regards to cycle analysis for more than 50 years. I mentioned up front I have a very interesting picture here just seeing, you are here for over 50 years doing cycle analysis. We are talking here about cycles, but you have already proved that cycles work. So Timergy just announced the top timers at these times. This is 1984, this is 2001, and yes, that's Peter here on these pictures, and I think we can nicely see how you evolved over time here. So. but the purpose is here for sure. You are looking back for really 50 years of market timing experience. You called big tops and bottoms ahead of time in the public, in the news. You managed large funds during these times based on cycle analysis. So I'm very proud really to have the time with you, because I think you don't need to spend the time anymore on doing this kind of discussion. And maybe that's the first question. You still do cycle analysis up to today, right?
Well, in a way, that's kind of a foolish question, Lars, because I know if I look you straight in the eye and say, when do you think you're going to stop all this stuff and getting up early every morning? And you think you probably get another 3 or 4 years, right? And you look at me and say, huh? I'll never stop this. This is a passion with me. I wake up and go to bed thinking about it. So this is the type of thing that stays with you all your life. Once you discover cycles and the efficacy of cycles and how they work, not just to define markets, but to define our lives, it's stuck in your brain forever, and it's not the type of thing you give up, and say, okay, I've had enough.
No, that's very nice. Let's talk a little bit about your framework or the usage of cycles. I think what we are doing here week by week is we are using digital signal processing to detect what I call dynamic cycles or time-based cycles. And you are using, I think that makes it very special, the usage of cycles, not specifically for timing, but more also to derive price targets. Maybe you can give just a quick primer on how you use cycles in your analysis.
Yeah, when I initially started out with cycles, which is, we're literally going back to the late 60s, early 70s of the past century. I make it sound like I'm a real old timer. When I first started studying them, I was very much into the the timing aspect, how many weeks between this, how many days between this, even how many hours between this. You'd come up with these cycles and you'd say, wow, this is fabulous. Look how this works. This is wonderful. And then there was a TV station in Los Angeles where I lived at the time. It was KWHY, and it was the nation's first all financial network. They would start at 6:30 in the morning in Los Angeles. Excuse me. That's when the market opens in LA, 6:30, and go through the complete market day. Later on in the day, it became an Hispanic station, but for market hours, it was completely stock market, and even an hour or two after the stock market closed. There was a gentleman that did a technical show. His name was Gene Morgan. And one day he had on a guy that he claimed did cycle projections, price projections. So I looked at it and I said, well, that's really interesting. Anyway, that's where the whole thing began, with the Hurst price projection technique. I started using that and became fascinated by it. And there's one thing that it kind of turned me around a little bit, Lars, and that's that, I mean, one can argue that, or one can argue whether the price projections are of primary importance or the time projections are primary importance. And they each have their own argument. If you were to say to me, listen, I know with a pretty high degree of confidence that sometime between October 20th and October 31st, there's going to be a very important market bottom. And I would say to you, well, okay, but like what price is it going to be at? How will I know when we're there, you know? And conversely, I would say to you, Lars, I know that the Dow is going to bottom at 22,523. And that's going to be where the low in the Dow comes. And you say to me, well, is that next week, or is that October, November? Are you talking about January? And I'd say, I don't know. So there are those two sides of the cycle analysis, one of them being time oriented, the other one being price oriented. Hurst gave a way of attempting to put the two of them together, to put the timing aspect together with the price aspect. But I got frustrated many times when I attempted to do that. And I ended up saying to myself and people that were subscribing to me through the years that I'm going to concentrate on the price. I can give you theoretically when it should occur, because the easy way to do it, let's say, for example, that I have what I call a nominal 20-week cycle. If I get a downside projection on that nominal 20-week cycle, let's step back a couple of steps and think about how a 20-week cycle would work. If it was ideal, it would go up for 10 weeks and down for 10 weeks. My price projections are given, at least in theory, halfway through a move. So either halfway to the upside or halfway to the downside, which would mean that in a nominal 20-week cycle, my projections would be given 5 weeks up from the bottom and 5 weeks down from the top. So when I get a projection, let's say a nominal 20-week projection, on an idealized basis, I should say, and it's a nominal 20-week projection that's due within 5 weeks.
Yeah.
That's the theory.
Yeah, and I think that that's very important what you talked about, because I think the time-based aspect of using cycles to do projections and the price-based aspect to use cycles to do price-based projections are two different approaches how to use cycles, and I think if both approaches at the end speak the same message. That's very interesting. I think that's just following time-based cycles is risky. Just following a price-based cycles, you never know when the right time will be. So
yeah, that's when you hit the jackpot, when you think that you've got both a time cycle and a price projection that come together.
yeah, and maybe we can discuss this at the end, but maybe we have such kind of situation these days or weeks at least. And maybe second, before we jump into the current analysis, I think the second part of your framework is specific because you mentioned also, Hurst, that you are using this nominal cycles framework. So you have a specific set of daily, weekly, monthly cycles at a nominal model, it's a so-called Hurst nominal cycles model. And you are using, I would call it minimum maximum to define your range, then which you call continuum to define someone. So you use a fixed number cycle length set, right?
Indeed, yes.
Yeah, and
again, but I emphasize the word nominal because nominal, which means giving a name to something, I call it a nominal 20-week cycle, but I don't let it limit me or the projections in terms of what they're telling us. And the price to me is a lot more important than the time. Because if I can give you, if I tell you next week that we have a nominal 4-year downside projection, 4 years. Now, remember what we went through, 2 years up, 2 years down, you should get the projection 1 year after a turning point occurred. So if I gave you a nominal 4-year projection that I just got within the last week, I should say in theory, it's overdue within a year. Okay. So that was the 1 year up to the halfway point, another year up to finish the projection, then 2 years to the downside, nominal 4-year projection. But I don't do that, and I don't limit myself that way because I've seen nominal 4-year projections satisfied within a few weeks after they were given.
Yeah, and
so,
and I think there are also maybe these additional approaches we have these days. I call it dynamic cycles or use digital signal processing to try at least to derive the current dominant cycle, which might fit into a nominal framework. So I think that's then interesting. That's just to explain that there are these different ways.
That's a good point, yes.
And maybe finally, you also touched on that. So I think time-based cycles or the confirmation based on these price targets, you just mentioned this briefly, happens when you are half passed through from the timing perspective. So I think we will see this in your charts in a second. From my point of view, and I don't know how you see it, this could also act as a confirmation. So if we have a time-based cycle projection and it show the top or bottom, whatever, we don't have confirmation yet. So it's just shown from a cyclic perspective. But once we passed half the length, if it is then breaking through these lines which you are using, we have a confirmation. We can also say we have confirmation on the time-based cycle projection we have, that this is valid. And in addition, by your approach, we then also can derive the price target for it.
Right.
So I think that would be, or that's fascinating me, trying always to bring both approaches together.
Yeah, and again, that's the ideal, to be able to bring both the time and the price aspect together is the ideal situation.
Yeah. So then why not jump into some charts, Peter, if you would like to share some of your analysis?
I'll be happy to do that. Let's do that. Let's start out with this. And we are this is a perfect time to be doing this video, Lars, because we are at such an interesting juncture in the market. I'm going to go through this S&P weekly chart. I have daily projection charts, hourly projection charts, 65 minutes actually, and weeklies. And I do monthlies also, but the 90% of my work is done, 95% of my work, or even more, is done on daily and weekly charts. Excuse me. So what we're looking at now is a weekly chart of the S&P. And let me right click here so you'll see what the offset is. So here are the default offsets on the weekly chart. And these are the half spans of the actual cycle. So 2.5 would be a nominal 5-week, 5 would be a nominal 10-week, so on and so forth. 10-week offset, nominal 20-week projection. So the one we're looking at now is a 5-week offset giving nominal 10-week projections. And let me just very quickly describe what's happening here for the viewers. What we do is set up a chart, and this happens to be a weekly bar chart of the S&P 500 cash index. And each week you have the range of the bar, and the computer puts a mark at the exact halfway point. Call it the halfway point, the average, or the median. Hurst used to use the term median. So you take the median of the bar and you'd put a little crosshatch there, and then you would join the medians together. So that median would represent the average price for the complete week, including or taking into consideration, I should say, highs and lows. Okay, so that's what this blue line is. The blue line that we see is the median price each week. When you try to do a nominal 10-week projection, you move this median over exactly 5 weeks, and this is what it looks like right here. So you notice here's the mid price at the high in mid-August, and that gets moved over 1, 2, 3, 4, 5 weeks. Okay, and where the crossing takes place above and below, you have yourself a nominal 10-week downside and upside projections. The beauty of this software, the way Stefan Scheuermann, my brilliant young programmer, the German young man who now lives in Dubai, but the brilliance of the program is that when you do a projection like this, and currently, let me tell you that we do have a nominal 10-week downside projection in the S&P. And as you and I talk, this little mark right here is where the market is currently, down 50 points at 38.51 on the S&P. So the downside projection calls for 36.25.31 to 37.52.57. Now, on the weekly charts, Lars, I do a projection, and then as Hurst directed with his initial analysis of these price cycles, he does it plus or minus 10%. So the actual projection is calling for 36.88.94. You see it in that box there, which says begin price and end price. They're both the same. So the projection for the S&P is 36.88.94 plus or minus 10%. Would you say 10% of what? 10% of the complete move from the high to the projected low. So if you take 10% of this complete move from 43.25, let's say, down to 36.89, you take that amplitude and you multiply it by 0.1, and that's what you add on and subtract from this line here, which is the exact projection.
Yeah.
So go on.
Maybe let's just recap a little bit for newcomers to your approach. If you open first again the selection of where you can switch between different nominal cycles, I think that, yeah, exactly. Just keep it as, I think, just to explain, that's the Hurst nominal cycle structure we see here, now, where you select which nominal offset here, then the 20 weeks or 10 weeks you use. So that's not what you switch just, I think I use this cycle. This is, you go over different nominal cycle lengths. That's your starting point.
Correct.
Right?
And the theory is that when you meet a cycle, you check with the next longer. Usually it's the next longer. Sometimes there are exceptions, but you check with the next longer offset to see if you get a new projection even further in that direction. So here's what we're going to do, and follow me along with this. What I did was I put a rectangle around this projection. I don't know if you can make it out. It's kind of shaded a little bit darker, but I put an exact rectangle over this projection. And now I'll right click on the offset and go to the next longer offset, which is a 10-week offset, nominal 20-week projection. And watch this. Okay, here's the projection box right here that I put a little rectangle around. So we don't have a guarantee here, but we have a pretty good sense that if we get down to this projection, we're also going to cross below this line, okay? And if we cross below this line, we're going to get another projection, and nominal, this being a 10-week offset, we would get a nominal 20-week projection to the downside. Let me give you an idea as to where that might be. Now, this projection is given and confirmed, okay? But it's the only one so far that has been given and confirmed. There's nothing further given to the downside. I want to emphasize. The rest of what I'm going to show you here is hypothetical. If indeed we meet this projection, then we would cross, at least in theory, we would cross below this line. Now, there are ways to meet this projection, I understand, without getting the mid price for the week below this line. And should that occur, then you could reach a bottom here. If you have a big down, either the rest of the, well, I don't think it's going to happen the rest of this week because we're now into Friday. And so even if we have a decline into here, the midpoint for the week's going to be around here somewhere. So next week would become the important week.
Yeah.
But if we cross into this territory next week, there's a pretty good chance that the midpoint will go below this line. If it does, then there's a way with TradeStation to do a little drawing tool and a Fibonacci price retracement line. And you start at the high here and say, what if we do cross below this line? We have a snap mode on. We want to get rid of that. So we'll have freedom of movement here. All right. So if we do get below the line, it's going to be somewhere around here. Okay. And if it's somewhere around here, let's say, for example, it crosses right here. I already have a line down here that shows what the projection would be. Notice again, this would be the halfway mark, and the projection would be right around this level. Well, this level is 33, 37, 66.
Yeah. So
that's not a projection yet. We're playing what if right now.
But we are close to just try to explain. I mean, to be clear, we don't need to get into your downside projection. We just need to cross this red line here. No? This is the line you've shifted into the future base there. So it's just the projection gives us some kind of indication that we might have a good chance that we will break through this red line here, which will then trigger the next downside projection, right?
Yes, and you know what I'm going to do, Lars? I'm going to switch from the S&P to the NASDAQ 100 because that at this point is a little weaker, but we'll see generally the same configuration, and we can see how that is lining up to look a little bit different. But the conclusions are very interesting. So here's the same setup. The 10-week, well, this is actually a 5-week offset on the NASDAQ 100, and it's given a downside projection. As you can see, we're getting close to it with today's weakness. We're getting close to that projection. The projection calls for this midline here, which is 11,179.51 plus or minus 10%, which leads to a final projection of 10,925 to 11,433. Okay, so that's the projection on the NASDAQ 100. Well, let's go back to the chart and say, okay, let's look at the 10-week offset. Let's say, and we've drawn a rectangular box around this projection, and we go to the next longer offset. And here it is. And the same type situation here. Here's the box, the projection box, okay? So what I did was say, okay, if this is the high and this is going to be the halfway point, I think it's going to be easier to visualize that if we actually show it. So a price projection line would start at this high, and this would be the halfway point right here.
Mm-hmm.
And so you'd get a projection right about here, and this would be the plus and minus 10%. So here's your projection box, okay?
Yeah.
That would be a possible nominal 20-week downside projection.
Yeah. So we're talking about, I mean, two shorter term cycles, right? So the 5 and 10 week cycle. In other terms, the current 5-week projections calls more or less to reach the June bottom, right? So that we get to a level or the low in June. But if
That's correct. This box is a confirmed projection, and here's the June low. Let me go sideways with it. You can see it's right in that projection box. It's the lower side of it. So this is calling for a test of the June lows, or very close to it. Okay.
Yeah, and
but
your conclusion is if we do test it, and I mean we are short in testing it, and maybe then if we do it next week, this would then also set up the next cycle downward projection, which you've shown here.
Now that would be, in theory at least, this area right here.
Yeah.
Now here's where it gets really exciting and perhaps really scary for a lot of people. If we keep this box in mind for a possibility of a nominal 20-week projection, let's go to our longest offset of all, which is, well, actually it's the second longest, 100 to 110-week offset for a nominal 4-year projection. And watch this. Look how close we are to crossing below there. So now, if we cross below here, and this tentative projection is telling us we almost certainly will, if this projection is met, it'll almost certainly touch off this projection. If we get anywhere, we don't even have, at this point, Lars, we don't even need to get down to the 20-week projection. We may be able to set off this longer term projection with a move into this box.
Yes.
And if we do that, now you don't base your projection on this high. You go, whenever you do an offset, you go back. If you're doing a downside projection, you go to the previous highest high since the last crossing. Well, the last crossing took place way back to the left off the screen. So this is the all-time high. That's the one that we would use to get a projection. So let's just, for the fun of it, of course, do a drawing line here, go to price retracement lines, go to this high that occurred in November of last year, and then come down to somewhere around here. If we cross these lines, the red line and the blue line, it's going to be somewhere in this general area. And again, you can see the line I've drawn down below here, right in this area. Well, all of a sudden, Lars, we're talking about 62.34 on the NASDAQ 100.
Yeah. Wow. Yeah. Yeah. And I mean, interesting is that we see a trigger of lower lows. So your cycle projections shows us if this cycle is confirmed by reaching this area, then the next cycle projection is triggered, which has the next low projection, and even the longer term cycle then will trigger the next lower projection. So my listening to you is that there are only downside projections right now, which we are looking for. So more or less, there's currently no upside projections from these cycles.
That's correct. And let me emphasize that this is a rare occurrence where you get this kind of thing where this one leads to this one leads to this one, okay? And you can do all that. And it's obviously a play thing because this is the only confirmed projection we have so far, this box right here.
Yeah.
That is a confirmed projection. Okay, now let's do this just for fun, Lars, to show you how this software sets up. Let's go back to the 5-week offset. And the logical question is, Once this projection is generated, which is this week right here, that happened 2 weeks ago, you ask the computer, well, okay, I can see that's a projection, but how good has it been historically? And I say, well, hold on, because Stefan has taken care of that contingency. Let's go to show statistics. And what pops up is a box that shows you all the projections that have occurred over a certain period of time. Right now, we have programmed in actually 16 years of data, 1996 to 2022. So for the past 16 years on the NDX, when this offset, this is for this particular offset, which you read right here, is 5 weeks. When this projection has been generated to the downside, it has been fulfilled 86% of the time. Now, that's very unusual. I mean, usually I look for accuracy in the 70s, maybe 72, 4, 5, 75%. An excellent analytical return would be if you got in the high 70s. And once you get into the low 80s or the mid 80s, those are spectacular results. That's telling you that of the 63 times that a projection to the downside was given in the last 25, 26 years, quarter of a century, it's been reached 54 out of 63 times. So 86% of the time.
I mean, just looking at this cycle and then adding the other cycles, it's a kind of cycles within cycles alignment. What seems to be around the corner. If you said it's a rare occurrence that you have the sequence of the shorter one triggering of the next longer one triggering of the next longer one. I mean, what Hurst or others would call also these cycles within cycles synchronization.
Yes, particularly leading up to this 100-week offset. I mean, you don't too often get, as you might imagine, because it's a nominal 4-year projection, you don't very often get crossings of this offset. Let me do this. I don't know how this is going to turn out. I may be sorry I did it, but let's show the statistics for this long offset. Yeah, see, it's not bad. 2 out of 3 times these projections have been given. This goes back for 26 years now. So you don't very often, let's take a longer view of this. You don't very often get a crossing. As you can see now, I'm going back. This is 2019, 2018, 2017. Now, this is interesting. I want to show this to you, Lars. This is what happened with the crossing in 2000. When was this?
9 or 10?
Okay, this is the big decline from 07 to 09. Okay.
Yeah.
But look at this projection to the downside. It's a fabulous projection.
Yeah, the downside projection. Yeah, and then
yeah, this is the 2000 high, 2007 high. Not only that, look at the upside projection here.
We had before.
Yeah, this is leading into the 07 high. Here's the upside projection. This is where the high took place right here. So then you had that high. You came down towards the offset. And as happens quite often, the offset acted as resistance. So you came down there and bounced off it. And then finally, well into 2008, this occurred in September of 08, you had this crossing and you gave this downside projection, and there you go.
Yeah, that's fascinating.
So that's where we stand.
Yeah, and one reason also I ask you maybe to have this joint discussion here is I would also like to bring in maybe some time-based cycles here into play. If you have some time, I would like to discuss here, which we discuss here on the channel.
Sure, I'd love to discuss them with you.
Let's continue. So, for example, this is the current time-based cycle, which we can identify. We see the spectrum here at the bottom. This is the current analysis doing a time-based cycle analysis, and there's one peak showing up here in the spectrum. Well, it's a daily chart on the S&P 500, which has a length of 175 days in this case, and this cycle here is just overlaid here on top in the top section here. What's interesting about this cycle, if you just go over the history of these cycles here, you will find that especially the points where we had the bottom here, I need to maybe give me a second, I need to move myself here. So the low points here, so the low timing of these cycles. Now, if you see where the bottom took place in the market, so I mean, here is a major bottom here from timing. It has a very interesting correlation, at least from timing past bottoms, just using the daily cycles here. No? So here.
And what is the length of that cycle?
175 days.
Okay.
But it's trading days. So if we
right,
and if we even move further into the future, so the final low here was, I mean, the top projection was not so it's a very short-term cycle, just talking about these 174 days. But and I think the top is already in the topping area here. So this projection more or less calls for moving down into end of the year. So just from a timing point of view. So this is not calling for another top. So we see this left translation here in the timing here, but the next projection is the next bottoming area, and I think this cycle was very important in projecting the timing on bottoms, but this is now projecting a down move into end of the year. So that's just the timing point of view from this cycle just for today. So but we did also a longer term analysis here during the last end of October. And this is what I also want to share with you here. So this is the long-term cycle. This is a 186. Oh, I don't know where to place ours. 186 week cycle. Which is a long-term cycle analysis here, going back over the last 20 years.
Well, you want to show us the bottoms, so maybe move us to the top of the screen.
Yeah, maybe we could also do it somewhere here.
Yeah.
And you see just aligning with the red line, aligning where the tops and bottoms took place of the cycle, just aligned to the raw price. And I think the period here between 2009 and 2020, from the absolute price movement, we saw the up move in the S&P, but the cycle timing is just not the relative swings. So it was nicely showing us the swings here in the longer term up move. This cycle topped last year. And so the long-term weekly cycle, we are just from a timing point of view at the half point of this longer term weekly cycle, which is also showing us a projection into summer next year. So even the longer term cycle, which is maybe also your longest cycle nominal model you used, gives us a very negative cycle projection here, calling for even lower lows into summer next year.
Interesting.
And we did this on different other data sets too. So for example, this is the St. Louis Federal Reserve Financial Stress Index, which is a composite measure of financial stress according to the St. Louis Fed. And this is more or less reading vice versa. So I mean, tops in the financial stress are then correlated to market bottoms and vice versa. So you see here the peaks in the cycle, and you see how nicely the 196 weeks, so this is a 190 week cycle, which is nicely working in this data set here, which is calling for a financial stress low also by end of last year. And this long-term cycle is pointing now upwards. The financial stress is pointing upwards. Right. Which just give us the conclusion that if financial stress now increases, prices will even continue to go down into the year of 2023.
Interesting.
And we can map this year, and you can do this on different other measures. And we reviewed these time-based cycles here during the last weeks, and I came to a similar conclusion like you did. So just looking at the time-based cycles, which I showed you, there seems to be a cycles within cycles alignment now, just triggering the timing is projecting into summer next year, just the next downswing. So there is not one single projection from a timing point of view, from digital signal processing, currently calls for a big up move currently.
And you know what makes that interesting, Lars, is that we understand, and I'm sure through your career in analyzing markets and learning about them, you've learned or read about different disciplines. The interesting thing about where we are cyclically now is that if you listen to some Elliott waivers, Bob Precht is a very good friend of mine, and we talk often about the markets. And their whole theory is that we have reached the top of a grand super cycle, and that we're about to go down for not only a long period of time, but very substantially in the market. So it's interesting that discipline kind of ties in with these longer term charts that you've shown, you know?
Yeah, and that's also a rare situation. I mean, you have been much more longer than me in this business observing cycles. But at least to say the last 10 to 20 years where I'm on the subject now, I've also not often seen this situation when all the different cycle analysis comes to more or less the same conclusion. Often you have disagreement in different cycle analysis. So a long-term cycle might show this, a short-term cycle might show this, and you're a little bit left alone. And okay, how should I read now the different outcomes here? And I don't know how you feel about that. And I've not often seen this situation where I say, okay, now the time-based cycle analysis speaks clear message. Your price cycle analysis speaks more or less clear message. Elliott wave have for a longer time clear message. So I mean, the outlook is not very positive if we bring this together. But
and let me give you, excuse me, and let me give you one more discipline, which has got nothing to do with market timing, and that's market valuations. Mm-hmm. Now, everyone's got his own or her own concept about how you measure valuation in the market. My conclusion after reading a lot of this material for a long period of time, there's a gentleman called John Hussman, Hussman. I don't know if you've heard of him, but his firm is called, I believe, Hussman Econometrics. And you can find him online, and you can find his market commentary online. I always emphasize to people that I never use market valuations as a timing tool. But if I reach an area where it's my goodness, we have reached all upside projections, and it looks like we could set off some very serious downsides. If I can substantiate that by looking at valuation, then it makes me feel a lot more comfortable with my outlook. Well, Hussman, and again, you can go to his website, Hussman Econometrics, whatever it is, and look at his market evaluation in terms of value. He has claimed now for at least the last year or two, and in fact, he's been quite bearish, probably overly bearish for a long time. And that's again one of the reasons why I say don't try to time the market with valuations. But even where we are now, which is S&P down 25% and the NASDAQ down around 30, even at that level, we are still now, Lars, in the most overvalued market in history, including 1929 and including 2000.
Yeah.
So where does that leave us, you know?
Same conclusion. I mean, it all comes together. I mean, these are very interesting times. I mean, it's a matter of perspective. You need to align now if it's interesting or not. But from the valuation perspective, from the Elliott wave perspective, from price cycle projections, from time cycle projections, let's see what happens. But I think the situation we outlined here. So I think that was the purpose for today. And I think good timing now, because we need to see what happens during the next 2 to 3 weeks. As you showed from your price cycle projections, it will be interesting to see if we reach this level next week. Then we have this price cycle confirmation, which you showed. And this is then in alignment. This is what I also wanted to bring up to the mix. This is in alignment with the time cycle projections. So
it's fascinating.
Fascinating times from a cycle analyst perspective. From a fund manager, you have to be very careful these days out there. Not easy.
Yes. It's hard to convince a lot of them of that, because they don't. They believe what we do is witchcraft. That's got nothing to do with it. It's the Federal Reserve. All you got to do is look at the Federal. Okay. You can't talk to people like that.
I know it's I mean, let's get back to that's also the purpose of the foundation. That's why we are here, because I think cycle analysis is not an accepted official science right now. It's kind of in the mix. So if you look at technical analysis, it's also not well known, not well established in the field of
witchcraft. That's all it is witchcraft.
Yes, but I'm working to get this nomination rid of. So cycle analysis is much more important than what you mentioned. But we both know about it, and you have proven for the last 50 years that this is the case. So. Thanks for sharing your knowledge, and thanks for sharing your current view on the markets, Peter.
It's always a pleasure. Always fun, Lars.
Yeah, me too. So I would recommend everyone, you also have your website, stockmarketcycles.com, where you share some more details. You also have a YouTube channel where you share some public videos. So I would recommend everyone move over, check Peter's website, check his YouTube channel.
Let me tell people, Lars, that we have, there's a little problem with the software now, because TradeStation is going to stop supporting third-party software. So we're not exactly sure what's going to happen with that. But I do a daily video. It's a paid video for subscribers. And that's available on a 14-day free trial, no obligation to everyone. So if they go to stockmarketcycles.com and they go to register up above, there's a dark green area where they can, don't take the free, there are 2 or 3 different areas to go to. The dark green is the daily video. You can get a free 14-day trial for that.
Yes.
So I highly recommend it.
Thanks. And I would also recommend everyone to follow your services. And maybe we can collaborate on the software and bringing the approaches together somewhere in the future.
That would be fabulous.
Yeah. And then maybe all members of the foundation can profit one time to see both coming together, as you're also a long-time supporter of the foundation. So I think we will find our way. Okay, so let's close it for today. We have spoken a long time. Again, I'm very proud to have you here, spend the time with us. Very great analysis, current markets. I think we will stay in contact during the next week to see what happens. Thank you, Peter.
Great. Enjoyed it. Thank you, Lars.
Bye.
Bye-bye.